The Pennsylvania Project and the Public Banking Institute present Public Banks for Public Works, Banking on the Commonwealth. This program was presented on October 18, 2014 at the Quaker Friends Center in Philadelphia, PA, as part of the East Coast National Symposium on Public Banks. This series of presentations covers several fundamentals of public banking, as well as related issues, factors, and opportunities. In this video, we present a panel discussion looking at the mechanics of public banks entitled The ABCs of Public Banking. The session is introduced by PBI and Pennsylvania Board Director Walt McCree.
Welcome back. Wow, right on time. 10 minutes late. That's cool. Thank you so much for returning and comfortable, and you've all had a little nap, perhaps, and we're all set to begin. We have got an interesting afternoon coming up. We're going to move from some of the theoretical conversation about some of the nature of public banking into the practicality of it. We've had an unfortunate absence here from Bob Hockett. Was not able to make it at the last minute. So we are going to take the opportunity.
We're going to boogie.
That's what the music's for. So we're going to have an interesting and I think a valuable conversation. I think perhaps even more important than talking about eminent domain and foreclosure, which is a bit of a niche in terms of the legal horizon. And we're going to be talking about the ABCs of banking relative to how to make a public bank. What does it take? And what are the various banking components that have to be understood in the nature of banking? So we've got, and from a couple of different perspectives. One is we have Jeff Beck. Jeff, I'm going to call you up to the stage. And now Jeff Beck is one of our members of the advisory board of the Pennsylvania Project. A very seasoned banker, had a very large role as a CEO and president, and I wound up with Advanta. I think it was a $15 billion bank, so he knows everything banking. And also on the panel will be Ellen. We'll be talking about, of course, what she knows about banking. She may have something to throw in. And also Aaron Lloyd. Aaron Lloyd is with the city of Reading. He's a special assistant to Mayor Spencer, who had to leave. Aaron has been a leader, really, in helping to take the next steps toward creating a public bank at the municipal level, because the city of Reading has got it in its sights. It's taken its bite. It's moving its assets, its understanding, and its mechanisms toward having a public bank. So, and we're going to have Mike Kraus moderate this and move the discussion forward, and then we're going to open it up to you so that you'll be able to get your questions answered about what would it take, what do we need to know about banking to be protagonists for it, as well as promoters of it with our city officials and so forth. And that's also that's a very important thing. So with no further ado, Mike Kraus. Yes.
This should be hopefully interesting. I'm going to start with Aaron and the city of Reading. Reading didn't have, when we first got together, the capital on hand from our bank. Under Pennsylvania banking law, you need about plus $12 million of what's called Tier 1 capital, free and clear, unencumbered, to capitalize your bank. And Reading didn't have that. So Reading was looking for models, different ways of doing everything, and one was a different way of approaching municipal finance. So we couldn't quite get to the bank level, and the city had another idea, which was to form an agency that would look like a bank on one end, take the money in, and on the other end, put it in other banks. But instead of going to Wells Fargo at high fees, the city would manage its own money. And instead of all 20 million going, let's say, their daily deposits to one bank, it would be parceled out to smaller banks in amounts for which they had an appetite. No one bank wanted all 20 million because it had to be capitalized. So let me ask Aaron to describe how the city of Reading moved into this idea and how they were trying to set that up. Then we'll go over to Jeff and talk about what it actually takes to get a banking charter, and then come back to Ellen's argument here new today about moving in this idea through the bond market and not a fully built out bank. Let's try that. Let's start with the not quite bank solution that Reading has proposed, and Aaron can explain why that is and how they're moving that forward. So let's start with you, Aaron, just a description.
All right. Well, thank you, and hello, everyone. Good afternoon.
Take it your hand.
Okay.
That's
So I actually was at the last conference here. That's when I first kind of really got involved in this effort. What was that, two years ago now? And at that conference, actually, kind of the idea kind of germinated, working with Mike and another fellow, unfortunately he's not here today, Tom Seguros, about the idea of taking a municipality's money and moving it out of Wells Fargo, you know, for example, who has our money now.
How much money are you talking about? As just folks know what we're talking about here.
So for the city of Reading, our annual intake, you know, in terms of all of our money, and that includes property tax, income tax, transfers from the state, our utility bills from water, sewer, trash, all these, you know, grants and et cetera, is about $130 million. And all that money sits in checking accounts. And I think the work we did to do the first feasibility study was a good exercise. We actually got to see like how many checking accounts we actually had, which I think was like 32 or something like that.
36.
36, that's right. I mean, I think we actually found one or two, but that stays in this room. And so, but the question was, I mean, number one, quite a few of them, I mean, high-level funds, including, I think it was our, one of our major capital sewer accounts was in a non-interest-bearing account, number one. You know, I mean, this is just a level of kind of like mismanagement of money that we do have at the banking level, which is not something that's ever really discussed much. You know, it's always about tax rates, you know, and you know, debt to income ratios and stuff like that. But the management of funds at the banking level is something that there, you know, is not a common like kind of municipal best practices. So even just starting to look at this stuff, you know, for those of you involved in this at the municipal level, I think is a very good exercise. So the idea was to figure out a way, now that we knew like, you know, what our cash flow is, how many accounts we have, who holds those accounts. In a municipal budget, you know, you have your peaks and troughs of, you know, cash flow. And one of the things we had to calculate was what was the minimum amount of cash that we almost always had on hand. And that was about $15 million, I think. At any given time, the city always had in bank accounts. And so the question was, you know, what could we do with that money? And it wasn't a lot of money, you know, because it just barely hit the kind of threshold that Mike just mentioned, you know, the 12,000. And I think that's like a good number. It's well, 8, I think, is the minimum.
And also your funds weren't liquid, they were pledged. To capitalize, again, to capitalize a bank, you need what's called Tier 1 capital, free and clear, unencumbered. No one's got a claim on it. What Aaron's describing is the any given day $15 million of city deposits,
right,
which are payroll and those sorts of things. It really wasn't available to form a bank.
Yeah. So we didn't even meet that minimum threshold. And so, you know, the initial effort was, well, we want to capitalize the banks. We need to find where this additional fund can come from that, you know, is not encumbered, that is liquid and, you know, is unrestricted funds. So, you know, you have to look at that in the, you know, in the breakout of, you know, your asset statements. And we decided, well, we were going to pull in our municipal authorities and do the same for them to see what the unrestricted access we had to some of those funds. And so I'm one of the directors of the Regional Water Authority, and we are kind of well capitalized. You know, water is definitely one of the best resources we have. And so we looked at what we had there, and I think the amount was 16 million. I mean, it was just completely like cash on hand. There was no restriction on that. And then we looked at our parking authority, and they had maybe about half that or so. And then our housing authority. You have all these different public agencies that all have bank accounts in different places. And the idea then became, you know, is there a way that we could take all of these kind of pockets of funding and kind of virtually pool them together to be able to capitalize something? And so I guess at some point we thought about, you know, just going the banking route, and that just, you know, we're just not there yet. It's just, you know, it's going to take years and years. So we thought of an intermediate step of beginning to phase those monies out of the I like the too big to jail mention that was mentioned earlier, out of those accounts, and then put them through kind of an intermediary agency that was set up by like the consortium of these public agencies. It would kind of be like the manager to each of the public entities. Then they would take that money and then they would set up arrangements with the community banks, the credit unions, those kinds of things, up to the capacity that they had.
Let me explain that, what was just said there. Not every local bank wants to take 25, 30 million worth of deposits because they have to collateralize that. But a bank might want 4 million of that, or 3 million, or 6 million. So the thought was that no one bank in town that we talked to said, oh, yeah, we'll take all 25. They actually, it was tied up too much of their collateral. They didn't really want that. Nor did they want to actually manage municipal deposits.
Right.
The big banks do it because they can afford to. A smaller bank, there's a lot of work in managing these, just small Reading, 36 different accounts within one bank for payroll. But local banks don't want to do that. So they didn't want to do that, and they also didn't want to take all the money, so we went from there.
Right. So the idea then was to take that kind of like management layer out from the relationship and create this, we call it a municipal finance agency, who would kind of be staffed. We kind of looked at, we would need about 2 full-time equivalents, like an executive director, and maybe 2 part-time people to kind of manage, the deposit withdrawals, and set them up in a room in a corner in City Hall or wherever we were going to do it. And it wouldn't be any retail activity. It would simply be to manage the transfers of the money between the agencies when they need to make payroll and et cetera, and then money that's just going to be sitting on the accounts. When we get our earned income tax, that money sits in the account for like 6 months easily and doesn't do anything. And oftentimes, the same is for each agency. And so to kind of create the timing for each one to make sure that, the cash flows matched up so that we were able to hit a certain level and then allocate that money to local banks. And the interest was real.
Yeah, what we found was the local banks did have interest in that, and it had a couple benefits, because up until this point, the city didn't really have relationships with the local banks. So this was a way to create those relationships, and we imagine this out loud. Walking around Reading, if you don't know, it's a very Hispanic city now. My mother's family is from there, all German and English, not now. It's 64% Hispanic? Yeah. So it's 64% Hispanic. So I'm wandering around, I speak Spanish, so I'm wandering around town poking the bodegas and saying, where do these guys get the money for this store? Not from any bank. From some high-interest lender is where they got the money. You just know that. So we're thinking, the city through its agencies is all over town identifying potential customers for the banks. In a way, it was marketing for the banks. So this was the benefit of a relationship with the city and its banks, which did not then have. So that's one way to go here. It's a bridge, and it might even be possible later on when the agent is up and running, then that becomes the host for the bank. Then it's got a track record, it's doing certain financial things, regulators are going to say, oh, you got some experience, and so you go from there, and the city, not directly, but its agency then takes lead on forming a bank. That's a possibility, one way to go. Now there's another way to go, which we're going to do with Jeff next, and that is you actually go for a bank. This sounds easy. Let's start a bank. And here's what's going to happen. All these communities will track about the same way. The first is we'll all get together and decide there's the political will to do what we want to do. Step one, that's what part of this is all about, and other towns. Step two is then, okay, is this feasible? You've got to look at your municipal law, which will govern part of what you do. You've got to look at your banking law, which will govern part of what you do. Okay, it's feasible. Then comes step three, getting a bank charter. Let me explain this one to you. You don't just go say, hey, Mr. State Regulator, I've got $12 million, can I start a bank? You actually have to come with a business plan that some state regulator will look at and say, oh, that makes sense, you're not going to tank. Because their job is to make sure they don't approve a bank that goes under. They don't look so good. So, and they're tough about this sort of thing. So we began with Jeff and some others with a discussion with the Pennsylvania Department of Banking to get the lay of the land. And I think Jeff made the comment is, well, they've seen this before, but never this kind of ownership. Lots of folks come and say, let's start a bank, but they're going, who owns this bank? Who are the 6 shareholders? You have 65,000 shareholders? You have 1.2 million shareholders? What are you talking about? That was different. But I'm going to ask Jeff now to walk us through some of the basics of what a regulator looks for in terms of giving you a bank charter. And to describe, I think first, there's a federal bank charter and there's a state bank charter. And there are different kinds of banks I discovered that do different kinds of things. There's a bank, there's a trust, and there's a bank and trust. And they do different things. So maybe Jeff could walk us through maybe the ABCs of what banking is and what getting a bank charter is about.
Thank you. The 2 words to remember whenever you are talking to a bank regulator, and most likely you will, safe and sound. Everything that their world is about safe and sound banking. So if you apply for a charter, they want a business plan, they want a governance plan, they want all the various policies in place that convinces them that the bank will be operated in a safe and sound manner.
For example, policies for what? Could you give some description of that?
Well, this certainly won't be inclusive, but they are going to want to see policies concerning deposits, operations, financial risk management, credit risk management. If you're going to outsource any activity, so for example, if it's a municipal bank and you say, well, we're just going to have this IT group essentially support the bank, well then you've got to have a whole series of policies that define how you're going to make sure that they are operating in the best interests of the bank and that the pricing meets market standards, all of that kind of stuff.
Security of information, confidentiality?
All of that, yes. So if you were to walk into a bank and they're not going to show you, but if you said, gee, I want to see the bank's policies, you're probably talking about, I'm going to say 4 to 6 feet of shelf space of all of these policies that essentially define how the bank is going to operate. Governance, I think, is a big issue, especially with regard to public banking. As we said, they're not used to that sort of ownership, so that could be a chink in the armor of safe and sound banking. The Bank of North Dakota has, I think, a wonderful model. They've solved that problem, but it essentially provides layers of protection against, no offense if there are any elected officials here, but for anyone who is elected to be able to essentially directly influence the operation of the bank. That would give regulators a lot of worry.
Okay, so now you're seeing the picture here. Here's Reading, and they haven't quite got the capital to form a bank, so how do we get into that, and where do we find the benefits for the local banking community, short of what a public bank can do, and where's the benefit for us? Then there's the next step. Okay, we've got the capital, and some cities and towns do, so we're going to have to form a public bank. Now you understand it's easier said than done, that you've got to get past, you've got the political will, then you've got to show that it's feasible, so something you want to do, then you've got to get a banking charter. And that's, as Jeff was explaining, that you just walk in and get a charter. They're not sold off the rack, So you've got to prove that you know how to operate a bank. It's safe and sound. I won't look bad 5 years from now if I approved you. There's always that part of it, One more question, though, Jeff. Could you explain the difference between a state-approved bank and the need for FDIC insurance, and a federal charter which does not need, but also then bumps up against the Fed, if I get it right.
Okay, in this country, there are two legal entities that can charter banks, the federal government and state governments. A federally chartered bank is either a national bank regulated by the Office of the Comptroller of the Currency, part of the Treasury. Used to be that there were federally chartered thrifts. If not, I'm not mistaken, that's gone now. If you are a bank holding company as defined by federal banking law, then you are regulated by the Federal Reserve Bank. The states charter a bank under their own law, and they are regulated by whatever name they have for the state banking commissioner in that office. The Bank of North Dakota is really unusual because it does not have FDIC insurance on its deposits. Since it doesn't have insurance, it is not regulated by the FDIC. It's not a national bank. It's not regulated by the Office of the Comptroller of the Currency. And it's not a bank holding company, so it's not regulated by the Federal Reserve Bank. Which means in this highly unusual circumstance, the Bank of North Dakota is a state chartered bank only regulated by the State Bank Commissioner Office. That's the sweet spot.
So can we do that?
Well, the issue is really, what does state law, 50 states, what does that state law permit? And according to our meeting, which I would never say that a meeting like that is conclusive. You can't just, somebody in a regulator's office can say something, and if you just accept that, that's a big mistake. But at least according to them, in the Commonwealth of Pennsylvania, the Commonwealth can only charter an FDIC-insured bank. Well, that's a law, and laws can change, but probably not, at the snap of fingers.
Okay, now here are two ends of this discussion. The first end is we haven't got the means to go right for a public bank. Maybe we can bridge it. We can back into it. We can do some useful things, create a relationship with our banking industry in town, get some money circulating, find the customers. We'll get happy with each other, the banks and us. That's one thing. At the other end is the idea that, okay, we're going to form a public bank. And we'll do all the things the Bank of North Dakota does. It will lend through banks into the community, drive down interest rates, participate in the bond market, return profit, all this other stuff. That's a large bank. Fully staffed, I don't know, it might be $1 million a year in staffing, the 10 key positions, not really sure, it's not small. What Ellen showed us earlier, I want to go back to, is an easier way to break into public banking. Yes, it's a public bank, but its initial mission is quite limited. The mission is limited to participating in the bond market because that's easier to do. It's not a big staff operation. It can be profitable. So I want to just ask Ellen to once again walk us through this idea, if you can. It was a lot to take in of how you get into a public bank with a small mission focus. That's easier to achieve, requires less startup capital, less startup staff, and it gives the state regulators less to look at because your business model is limited. And I just make that assumption. I'll ask Jeff to vet that later. That if your mission statement is more limited, then they've got less to worry about. Now, that might not be a true statement, but if Ellen could just go back to the getting in the bond market game and how that might work.
Yeah, I would think if you don't have private depositors, why do you need FDIC insurance? And because it won't do your public deposits any good, right? So maybe you could get out of all that regulation. And I'm not sure I can remember all those numbers. I actually changed my
No,
slides.
let's stop there for a second. That's
5 this
interesting.
morning.
Maybe under that model, you really aren't looking for a banking charter. Maybe you're creating what might also be called a municipal finance agency with a limited focus of which is to go in the bond game. Maybe that's really the step we're talking about, and you don't need a bank charter for that. I don't know, Jeff. Does that sound reasonable?
Well,
if you're just buying and selling bonds, do you need a bank charter?
Well, but you're leveraging your deposit, or your capital, right?
Well, no, you don't need a bank charter to do that. One of the issues that you do have to worry about, and I'm not a municipal bond attorney, but if memory serves me, decades and decades ago, when interest rates were volatile, municipalities were able to save a fair amount of money by refinancing higher cost bond issues, and for whatever reason that still defies logic in my mind, the federal government said, no, you can't get that and use the windfall for you, we're going to take it. I mean, go figure. So, but it seems to me, clearly if you had a bank charter and you were following Ellen's model, that's the bank is buying the bonds or could make a loan to the municipality, or there are any number of ways, because since it's a standalone entity, especially if it were owned, for example, by the pension fund, it's legally removed, I think, from that law.
And you keep the windfall.
And exactly.
You keep the
and
windfall.
You keep the windfall.
Now, just understand what's going on here. There's more than one way to skin a cat. That's what we're saying here. We all know where we want to go, which is keeping our money at work locally for local purposes. But how we're going to get there, as we're beginning to hear, could vary widely in terms of mission, in terms of model, in terms of these are some of the things that we're now moving into as this effort moves to a different phase, as it were. And we've got the needs case. We know why we want to do this. Now, in certain places, that we'll go forward to feasibility studies. Now, how can this be done? And we'll tackle what kind of mission you've got in mind. And is that feasible? Is this kind of bank, that kind of bank? And then you get into, do you need a bank charter? And if so, how do you get one? I want to come back now to something. Aaron and I had a conversation the other day. And Pennsylvanians will know about Act 47. Certainly Aaron does. You saw a look on his face. That's where the Commonwealth puts you under receivership, and they tell you how to run your life, basically. And they come with things they want you to do, little metrics they want you to meet. And Reading's just had that experience. And Aaron made this comment, well, they gave us the metrics, but, and I'll let him finish that thought, and it kind of defines our problem.
So we've been in Act 47 since 2010. And it's like a pre-bankruptcy program, early intervention, and the pension crisis is the main thing that pushed us into it. We can no longer meet our minimum obligations, and we're running red, and so the state steps in. And so the first year, we had a $15 million hole in our general fund budget. Of about, at that time, it was about $85 million. So it's a pretty significant hole. And we painfully made cuts, reductions, restructured, refinanced bonds, wherever possible, and all those other callable debt, all the fancy foot stuff, and limped along. So now here we are, nearly 5 years later, at the end of their first 5-year plan, and this fall we have a $15 million hole again. Right back to where we started. The only real tools that this Act 47 program gives you is the ability to have a little more leverage over your negotiations with your bargaining units, police, fire, non-uniform labor. And so, and you have the ability to tax commuters higher than you would otherwise. So, the people who come into the town, pay a little more. But that's it. That's the extent of it. I think we got a $500,000 DCED grant sprinkled in there too for some things. But but nothing substantial. And so here we are getting ready to amend our recovery plans every 5 years in the program. Scranton's been in this program for over 30 years. Those of you who follow these kinds of things. They're trapped. Pittsburgh's in it and can't get out even though they're making progress. So we're getting ready to amend our 5-year plan for the next phase, and it just gets uglier and uglier, And all of a sudden now, just happened, what was it, Thursday or Friday when I was talking to Mike, the House just approved the Senate's amendment to the Act 47 bill, which is going right to the governor's desk, to turn Act 47 into a welfare to work program. They're actually mandating that you can only stay in this program a fixed amount of time, 8 years, for those of us that are within that window. You get a 5-year effort and then a 3-year extension, and then you're done. And then where you're at that point is that's it. And then really the only stage at that point is for the state to step in and take over. And that's what's happening right now. And no new tools were given as part of this. Nothing substantial.
So is that like in Detroit, that they would put in a manager? Oh, would that be like in Detroit, where they'd actually put in a manager and you're basically insolvent and bankrupt?
Correct.
Ooh, scary.
Yeah.
And do you get the sense that any of this is intentional?
Well, I think a big part of the problem is that there's no creativity at the state level. There's no innovation.
Let's just shift Mike Rose around. Oh, okay. I'm going to answer Ellen's question. Of course it's intentional.
Yeah.
Why do you make a problem if you don't have the solution in mind? I mean, seriously, we bankrupt our schools. Oh, they're just so terrible. We need charter schools. We don't have any infrastructure. Oh, we just got to sell it off to the ABC company. They've got them. They'll fix it up. Oh, these problems don't get made. Really, if you don't see a hidden hand here, you're really not paying attention, in my opinion. I mean, this is earlier today, Ellen pointed out that the Federal Reserve did something seemingly nonsensical. It said that big banks can't hold muni bonds in their portfolio, they're not liquid enough. Well, that's true. They're not as liquid as corporate bonds, but they're really secure. Now, on the other hand, corporate bonds are so liquid that in the last meltdown, in 2 weeks, 2 hours, they were gone. The big boys were out, and everyone else was holding the bag. They just evaporated that market. They're that liquid. Why would the Fed set up a pending municipal crisis in capital budgets and expenditures? Why would they make it hard? Why would they make it more expensive for cities and towns to borrow money? Why would you want to do that? Well, maybe there's a solution out there. Somebody else steps in and takes over infrastructure on the private sector. That's. I'm not big in conspiracy theories, but just because you're paranoid doesn't mean they're not out to get you. I mean, I think we're keeping that in mind, at all times. And this is, by the way, another comment. Personally, I'd rather be regulated at the state level. They haven't done such a bad job. First of all, no bank in Pennsylvania has 17,000 subsidiaries. I mean, the biggest banks collectively have, 47,000 subsidiaries? How do you regulate that? Well, the answer is you don't, obviously. That's how they collapse. They don't get regulated. Well, let's come around. Ellen, you were going to make a comment, though, about getting into the, or maybe it was you, Jeff, about getting into the bond market. And do you or not need to be a bank? And you said no, not necessarily. Did I hear that right?
Yes.
Okay, but if then you lend the money that you're making in the bond market, then do you need the bank charter?
No, what I was, again, this is old memory, and I'm not an attorney, but it seems to me that you could maybe get around this issue where, for example, if Reading were to directly go out and defease a bond issue because they can get the money more cheaply today, and they just have to turn around and essentially give it to the federal government, see, that's like, why bother? You could use a bank charter, and at least in my mind, it works best if the bank charter is owned not by the city, but, for example, the pension fund. And whether the bank buys the bonds or whether the bank lends the money to Reading or however the actual money flows, The bonds get defeased, the profit goes to the bank. The bank's owned by the pension fund, and the excess, I'll call it excess return, can go into the pension fund in lieu of the city's contribution. So net, it's like it fell into your general fund, but it didn't, because it just directly got into the pension fund.
Could you define defeased? Could you define defeased?
Okay. If you have a bond issue, and it's callable, meaning, at any time you can say to the bondholders, we're going to pay you off, give us the bonds back, we're not paying any more interest. That's calling the debt, and it's gone. Defeasing means you have a high rate bond issue out there that's not callable, but it's high rate. So what you do is you issue new bonds at a much lower rate, and you put that into I don't know the legal entity, but I'll call it a trust. And the interest and principal earned in the trust is used to pay the principal and interest on the old debt. So in essence, what you've done is you've defeased, you've financially taken care of the high cost money, and now you are paying out on the low cost money, and that's a significant financial benefit.
Before we go to questions, I just sort of a little summary here. What we hope you're seeing is that it's one thing to say, yes, let's have a public bank, and another thing to get one. And what is going to happen is it's going to track differently in different communities, depending on what their capacities are. Like Reading's capacity are not the same as Pittsburgh's. It's not sitting on $11 billion of investment. It's not going to go that route. It may be that it's a public bank route, but it has the limited mission Ellen described earlier, which is get in quick, get in early, get profitable, small staff, small everything, turn a profit, and then go forward to the public bank. What Jeff has described is if you go forward to a public bank, well, you're going to have to get some authority, federal or state, to give you a charter. And they'll have to jump through different hoops to get that charter. But as he said, safe and sound are everybody's watchword. So bring that all the way back to the beginning discussion today. When you're looking at setting up a public bank, here are the things you've got to think about. Mission. Apart from, yes, it gets affordable credit going, and yes, it turns a profit, and yes, it drives down our debt service, what specifically might you want that bank to accomplish? In this city, it might be doing something with 40,000 vacant properties. In another city, it might be doing something, setting up a technical industry. In other cities, it might be different. It might be infrastructure, it might be projects, it might be neighborhoods, mission. Then you get to the almost a $64,000 question, governance. What is going to persuade regulators that won't be run by politicians? And for that matter, what will persuade you that it won't be run by politicians? Not to put politicians down, but mean they can't be involved in the day-to-day management of the bank. They can't pick employees. They have no say in lending. They simply that it would tank overnight, more or less. How do you accomplish that? Third, things Ellen described, where does the money come from? Bond issue? Maybe. Rainy day funds? Maybe. Jeff was saying pension funds? Possibly. Okay, we can't do that. What's the middle step, which is Aaron has described here? There are ways that the city can bring its money home, get it circulating locally short of a public bank, and maybe that's a step to a public bank. So the purpose here, I hope we fulfilled it, was to take our thinking beyond, oh yes, we know we need this idea, and beyond, is it feasible? We'll get to that, but into the mechanics of how you actually can form a public bank, quote unquote. So I hope we fulfilled that purpose, but let's go to questions now.
So my question is related to something Ellen said earlier regarding a limited vision way to get into this idea. And I guess I first have to ask is who in the room might be familiar with peer-to-peer lending? Okay. So, and probably someone else could explain it better, but all I know is that it's what kind of an outfit are they in terms of, do they have a charter to do what they do? Does anyone know? Do they have a charter?
I don't think so. They wouldn't be leveraging capital, taking deposits. So it's really just a, yeah, private loan.
Private lending. And so going from that, I know that it seems that they operate in many states, so they're not governed by any one state?
Just an example, it was in Pittsburgh. There was an ex-cop that had a private business going and just started making loans. I forget what his business was, but he was just, people would come to him, put money on deposit, he'd make a loan. Everyone was happy except the state banking regulators. So they came and said, "You're a bank. You've got to stop this." And he said, "Well, they're paying me back more or less. I'm happy, they're happy. What's your problem?" Problem is you're a bank. You're in fact taking deposits and making loans. You can't do that. Stop. And they put them out of business. So what peer-to-peer is just one-to-one. You go out there into cyberspace and throw crowdsourcing. And say, I want to do this. Want to loan me some money? And somebody does. That's a private transaction. But the moment you hold somebody's money, looking like a deposit, and then part of that goes to somebody else, that's banking. And the state shut that guy in Pittsburgh down. He was a retired cop, I think, and just was doing a great job in the neighborhood. People loved him. State hated him.
So how do the peer-to-peer lending outfits get to do this?
It's private business. You just advertise, "I got some money to loan, do you want some?" And somebody comes to you and the two of you cut your own private deal. It's like, matchmaking. Yeah.
Okay.
But it's all private money, private transactions, and no one there is
Thank
holding
you.
deposits.
Thank you. I wanted to ask, with the Fed's new rule regarding the liquidity of bonds, does that create a crisis and a necessity for a state bank and a city bank?
I would think so. The state treasurers are quite concerned about it. They think there's no need for this, and they're questioning why it's being done. I did read one possible reason why it's being done, or I figured in my head this is why. They're short on high-quality liquid assets for the repo market because of all this quantitative easing where they've bought all these short-term assets off the books of the banks, treasuries particularly. They don't have the treasuries for the repo market. So they're creating a new class of assets that are considered high-quality liquid assets, which are really corporate bonds and corporate stock.
That can then be rehypothecated.
Right.
I can't even say the word.
Rehypothecated. So I'm not really sure why
Repeat after me, rehypothecated. Get to know that word.
I'm not sure why municipal bonds wouldn't qualify for that, but maybe you know.
Would it behoove the states to buy back their own bonds? Municipalities to take their bonds back at a discount?
That would be rather like financing your own infrastructure. You don't really need the bonds. You just make a loan to yourself. I think the Bank of North Dakota does that, right? They make loans to themselves.
And they make loans. The last major water project in North Dakota was $38 million a couple of years ago, and there was no bond issue. The state bank just loaned this entity the money at low interest, and they pay it back. The interest comes back to the Bank of North Dakota. So the people loan themselves some money, and they pay themselves back with interest to themselves. That's a nice arrangement. More questions? No?
Sounds a little like Obamacare for banking. But anyway, this question is for Aaron. You haven't said yet whether you think that the state regulators that are looking over your shoulder are going to let you actually create this new financial agency. Have they given you permission? Do you anticipate that they will?
We've had some sidebar conversations with Secretary of Banking, Moyer, and there doesn't seem to be any impediment at the level that we're doing it because the money still ends up in real banks. So in that sense, intermediary work that we're doing allocating the money to different banks does not get in the way of the regulatory oversight required for final deposits.
Another question would be, do you think it's going to allow you to get out of receivership?
That part of it, no. But we do have a bigger strategy, and I won't take up too much time talking about it, but basically we're faced with two roads. The first road is to simply let the current path play out and run out of cash and let the state come in and take over. As part of that restructuring, they're going to take every major asset we have, probably try to privatize the hell out of it, and cut public services and staffing and all those other things. The other avenue is for us to take control of our destiny by leveraging our assets, and that's what we're looking to do, like our water system, monetize it ourselves while keeping it public, kind of like a reverse mortgage to stay in your house. Then using that money to pay our callable debts, to fees, the high interest stuff, maybe cut some taxes to do some stimulus, and then the balance of that money, capitalize a real bank, a real public bank. Do it now while interest rates are low. Take money out of the public, out of the private banking system, and use it to create a public bank, and then service that debt with assets like our water system that have a positive cash flow and can service that original debt.
That sounds really interesting, but I think maybe it went by a little fast. Could you say what you mean by monetize your water system?
Sure. So we have a water system that's very comprehensive. We have a lake and a distribution system that's probably worth at least $250 million. And so here's I could talk all day about this, but I'll try to keep it succinct. So the state, in its concern, infinite wisdom for cities, said, well, Act 47 is not enough, because when we went into Act 47, one of the things we did was we couldn't raise we did raise property taxes. We did probably about a cumulative 25 to 30% rate hike over the initial few years, but there still wasn't enough. And now, again, we're dealing with, our pensions, skyrocketing again because the state stopped contributing towards it at the level that they were earlier. And so we had to look at other revenue streams to help balance the general fund. And so we looked to parking revenues and to water revenues. And those authorities began contributing kind of like their surplus revenues back to the city simply as transfer payments to allow us to try to balance the budget every year. So the state decided, well, that's not a good idea, because the ratepayers should solely be paying for whatever it costs to produce the service, whether to treat the water or to, force parking meters. So they put in another law called Act 73 2 years ago, which restricted the ability for municipal authorities to make gift payments back to the parent municipality over and above whatever the kind of formal lease arrangement was for the curb space or for the water plant. And so basically shut off the ability to take in those revenues. So now, while we could be making money off of these things, the state is actually prohibiting us from doing so. I mean, you really have to wonder what the intention is in Harrisburg in this case. So what we decided to do was, okay, if that's the way that they're going to do this, we are going to kind of liquefy the asset, have the water authority, for example, do a bond for $250 million and create a new lease, because we already have a 99-year lease with the city, and pay the 30, 40-year lease arrangement up front. And kind of like Allentown did this, actually, if you're familiar with this. However, we would not go out into the private market to allow Pennsylvania American or Aqua come in and bid on the deal. The authority itself would simply do like a reverse mortgage on this asset, and then we would use that funding. All payments, we have annual payments to the city of about $16 million right now. But that was negotiated in like 1994, and so the value of water is much more now. We're paying very low rates compared to the private water systems around us. So we can afford to raise rates, service that bond, and still make a difference. And then take that money And you could do the same with your parking system or other cash-bearing assets like that. But you got to be very careful. We're well on our way with our plan, but then we ended up in a fight with City Council because they saw dollar signs, and several attorneys that are into this privatization scheme came along, actually several of them, which are Act 47 coordinators of other cities. So follow the money. So this is what's happening. Wall Street got us in the mess we're in with the pension market and the housing market. Now cities can't afford to service the debts created both in their own house and in the local economy. And now the Wall Street profiteers are basically coming in with these privatization schemes to take the last bastion of public assets away from cities for the next 40 to 50 years, the next generation. It's a mess. And it's not going to be dealt with unless we come forward with this and try to come up with innovative public strategies.
So I think a takeaway here is today, let's get busy and help Aaron.
Thank you for joining us for this presentation from the East Coast Public Banking Symposium, Public Banks for Public Works, Banking on the Commonwealth, held in Philadelphia's historic Friends Center Meeting House. For more information about public banking and the movement to create a national network of new public interest banks, visit the Pennsylvania Project at publicbankingpa.org. Or to learn about the national project and access a variety of educational information on the topic and developments in the field, visit the Public Banking Institute at publicbankinginstitute.org.